Well, thank you so much for tuning in to this conversation around, or rather post-policy, with two eminent gentlemen, Ananth Narayan and Rahul Bajoria. And let me cut to the chase straight away. Remember, from the looks of it, from what the government or from what the RBI has said, normalization is out of question. Growth lowered, inflation expectations high, largely all on expected lines, Ananth?
I think so, Niraj. Look, frankly, the RBI is facing a very, very tough context. Seen over a 2-year period, Niraj, our growth, in fact, our GDP is lower than what it was 2 years ago. Inflation has grown by about 5.7% compound annual over the last 2 years. So I hate to use this word, but it's almost like stagflation over 2 years that we're grappling with right now. That is any central banker's worst nightmare. You wouldn't want to wish it on your worst enemy. So given that the RBI is trying to balance that out, clearly it wants to give growth a chance. It's also worried, like all of us are, about how inflation could pan out from here. Because despite the reduction in demand and growth, etc., unfortunately, inflation seems to be on an upswing. And we don't know how it will pan out given commodity prices, oil prices, food prices, and supply disruptions. So given what it's facing, I think it's done the best thing possible. It's tried to give growth a chance. It's clearly weighed in trying to support the government in whatever the government is doing. Primary focus, I think, has to be the fiscal response. But the RBI is playing an admirable, supportive role in the whole process.
Yeah. Rahul, you want to weigh in on this as well? Because somehow the bigger move also seemed with regards to yield management to stress on smooth liquidity management, orderly G-SAP borrowings, very vocal and defined G-SAP as well. Your initial thoughts?
Yeah, so I think Ananth summed up quite well that, RBI is trying to do
as
the
expected.
best they can. But I think, one of the interesting things is that even though RBI has been reasonably consistently dovish in the last 6 to 9 months, there was a sense within the market that, the RBI would eventually move towards normalization. I think today's policy, with the GDP downgrade, with the slight, very subtle change in the forward guidance, and the fact that, they have very clearly said that normalization is not something that's going to be considered. I think maybe that particular chapter will be closed, at least for the next few months, right? I mean, I'm not going to rule it out next year, but certainly in the near term, revival of growth and at least having some visibility of a sustainable recovery is what the RBI will probably look for before, any normalization issue comes in. I think Ananth is absolutely spot on that, the primary role of growth revival, whether it's through actions or through spending, has to be there from the government, right? So I think there is expectation that there will be some fiscal steps taken. I think from here on, with the RBI meeting out of the way, our gaze has to shift towards Delhi to see what they are going to do.
Yeah, most certainly. Now, just before I come to some nuances of the policy, just a quite forward-looking question, Ananth. But do you reckon there is the RBI is probably doing the right thing and the thing that it needs to do? A section of the market may be fearing that, much a la what they think about the Fed, is that whether the Fed could be caught on the wrong foot and be surprised. In India, more so with crude and with food inflation looking the way it is, could the RBI be caught on the wrong foot? And there's not much it can do about it, I agree. But could there be pressure, despite what the RBI wants, for the RBI to act on the rates front sometime during the end of the year or the first quarter of the next calendar?
As I said, it's a very, very tricky situation for the RBI, Niraj, and I'm glad I'm not there in their shoes. When you're faced with the prospect of inflation and you're staring at a reduction in your growth estimates after that debilitating second wave, there isn't much really that the RBI can do at this point in time. The reality is inflation at this point in time is not monetary. It's not money or demand which is causing inflation. It's supply side constraints, it's commodity prices, it's crude prices, a whole host of other things. At the same time, you're worried about inflation credibility. It's one thing to say interest rates are not causing inflation, but the moment you relax on that, especially for an emerging market, and we've seen this movie before, if you lose that inflation credibility, the markets can punish you over a 3-4 year, 5-year period. There are a few silver spots as though, Niraj. One is the fact that because we've had this enforced austerity in demand over the last year or so through COVID, our imports came down. And global liquidity meant a lot of money came into our country, right, through FDI as well as through FPI and equity. That meant that RBI now is sitting, as Governor mentioned, on over $600 billion of reserves. Now, that gives us an immense amount of degrees of freedom for the RBI to be a little relaxed as far as inflation and interest rates are concerned for some period of time, right? And I think that's what the RBI is betting on. Yes, it could be caught on the wrong foot, but I think the reserves gives us ample buffers for at least a year or so before that wrong foot starts to play out. In the meantime, the real economy has to respond by actually upping supply, by upping domestic output, and by creating jobs. Eventually, the real economy holds the answers through fiscal pushes, as Rahul rightly mentioned. RBI has some time and leeway thanks to its FX buffers. Within those 1 or 2 years that we have from those FX buffers, hopefully things will play out well. But you're right, it is a tricky position for the RBI to be in because there are lots of imponderables and lots of paradoxes it has to balance.
Yeah. Just a follow-up there, Ananth, and that is on the moves that the RBI has done. For example, I mean, there is no doubt in anybody's mind that if there is a body that has been at the forefront of aiding the economy, it has been the central bank, right? This time around, some small measures, the SIDBI measure for MSMEs, or the nudge to banks, not the nudge really, but whatever, for the contact-based industries and some shops out there. We don't know whether the banks will actually do it or not. Do you think that's all that could have been done? Could there have been more? Or do you reckon that the RBI has done what it has done and the ball is now on the fiscal side?
I think the good thing about this RBI since the pandemic and even before the pandemic, to be honest, it's very, very responsive. So I think all of IBA's requests and demands, all of small finance bank, MFI demands over time have been met, in some cases proactively. Now, even today, I heard the CEO of IBA mention that pretty much all they've asked for has come through. This 50 crore expansion, I think, is good. The specific windows going to contact-based services, I think, is fantastic. There is still a few more asks that the industry has, but I think RBI will be pretty responsive in that. So I agree with you, Niraj. I think the RBI has been at the forefront of the pandemic response, both in terms of providing relief, forbearance, moratorium, and trying to instill some kind of a recovery. I think the ball is clearly in the fiscal court and in the real economy right now, to be honest.
Rahul, you mentioned this, that the point that just Anand ended with. Is there something that the RBI could have done, or you would have hoped that the RBI would say, which the RBI didn't?
No, I think it was along fairly predictable lines. In fact, the decision to include the STLs into the G-SAP program, I think, will also give some comfort to state governments as well, right? Because they are likely to also be at the wrong end of the stick, as far as the yield increase is concerned and the borrowing requirements are there. But I think maybe a little bit more could have done for the rural sector. I think, obviously they had laid out some measures back in the May, press conference when the governor came out of schedule to announce a few measures. I think because this time around, because the penetration of rural COVID is quite high, there is a risk that, our sowing cycle might get impacted. So I think the rural area and the activity levels over there are very, very critical to manage, over the next few months. So I think, maybe we'll see a little bit more action on this side in the next coming months and weeks from the RBI.
Okay. Now, I would want to end with a couple of thoughts from each of you on the FX measures, as well as, what does this do for savers? But just before that, one view from both of you on this ample supply of liquidity and the fact that, I've been watching from the sidelines the whole auctions that are happening and how the last one also underwriter saving. There's just so much of supply and liquidity in the market currently. Can the RBI do something in order to address that? Because obviously it is coming out and doing these auctions, but are there tools which can be used, not being used currently, which you would love to see? Rahul, I'll start this question with you and then go to Anand.
No, I think as far as the supply dynamics are concerned, clearly, we knew that the supply of bonds is going to be very, very big. And, while there is plenty of liquidity, I think the appetite to buy these bonds at the current price levels is low. So from that particular standpoint, my hunch is that, the RBI, even though they've clearly said that, they are not into targeting any particular yield, but there is at least a belief that these yields should not go up, right, materially, even in the face of supply. And given the very comfortable cash position that the government is sitting on, maybe it gives them a little bit more wiggle room, given that the net supply that RBI itself is absorbing. But this is not a long-term solution, right? So from that particular perspective, measures to either increase demand, so either through income generation and then greater savings in the system, or having new avenues of bond market or bond demand coming in through FPIs. And there were a couple of steps today that were announced to try and improve the settlement process and improve the accessibility. But then I would still think that RBI remains a very dominant buyer in the system, at least for the next couple of months, till the time you maybe see some visibility around credit growth, and you see some visibility around whether RBI is comfortable letting the yields float up a little bit higher.
And any thoughts that you have on this?
I think Rahul covered it very well. I'll just add a couple of quick points. I think the reason why the government has managed to raise all of its financing at record low yields is because of the RBI. Let's not forget last fiscal year, between center and states, I think they raised about 23 lakh crores of gross borrowing. It's a record number, Niraj. As an old trader, I've never seen these kind of numbers being borrowed. It's to full credit of the RBI that a combination of OMOs, these unconventional measures like Operation Twists, the G-SAP, and of course, nudging banks to buy by flooding the market with liquidity and therefore getting them to buy assets, has ensured that if they had not intervened, they did since February, the yields for the 10-year bond would have been closer to 6.5 at this point in time. So can they do more? They've already done a lot to bring the 10-year bond to 6% and stop it from going higher from here. So I think they've taken a completely hard stance that they want to ensure that the yields are controlled. Rather than saying what more can they do, I would appreciate the fact that they've already done a lot to control yields and term premium to where they are right now. Otherwise, the markets would have taken it much higher.
Yeah, maybe I'll ask you the final question, Ananth, about what can they do if they can do anything from a saver's perspective. But just before that, because we talk about the policy from a corporate perspective and the GDP perspective, and what about the saver's perspective? But Rahul, to you, the FX measures you mentioned just before we went on the show, that they seem a bit interesting to you. I know we haven't even gone on to the growth forecast number because there's such a small revision that I'm not kind of bringing it up in the larger scheme of things. But the FX measures you thought were very interesting. Can you talk a bit about that?
Yeah, so I think overall the interest in the way the forward premium has been sort of jumping around. It was very elevated through the early part of this year, and now it has been coming down very sharply. And there is a suspicion that it could be a lot of receiving in the forwards is being done by the RBI. I think this increase in foreign reserves might be a direct corollary of that particular action, right? Where we are running down our forward book, trying to reduce the cost of hedging. And so maybe the RBI is creating some cushion room, for importers to go out there and hedge, their forward purchases at a lower cost, simply by letting the forward premium come down, right? So from that particular perspective, maybe there is a lingering concern around inflation, particularly in the face of higher commodity prices. But, it is a dynamic worth watching, because the hedge ratios certainly were quite low, because, importers were quite comfortable with the idea that RBI is not going to let the INR weaken. But then at the same time, now when commodity prices are rising, I think looking at import covers and looking at import hedging ratios becomes quite critical. So maybe, that's one way to interpret it, is that RBI wants more hedging to go into, especially by our big importers.
You reckon, Rahul? World over, we're now starting to see the talk of the taper happening, right? The central banks down south have kind of started speaking about it. Sweden, etc., UK have acted on it, and the Fed, for all we know, might be preparing the script, if not the actual thing. Do you reckon that there is a risk to the currency over the course of the next 6 months moving southwards, or no, not really?
So what we have been telling our clients is that the demand supply dynamics of dollars in India has become much more balanced than what we had last year. There is not the overwhelming supply of dollars, both from the current account and the capital account. So as and when growth does pick up, we will see our current account start to widen a little bit more. And so from that particular perspective, having a little bit more laissez-faire approach in the currency markets makes a little bit more sense. The RBI does not have to be that interventionist. So And with fears of inflation coming back, I think it is there. It is a lingering concern, even if it is coming from supply side measures. So maybe leaning on the FX at the margin, because there's very little we can do with rates right now, it would make sense to me. At least as a tactical policy measure, not really as a strategic tool to be deployed.
And the second last question on this conversation, and can't not ask you about the currency and the yields. Your sense there, Ananth?
Okay, sorry. Currency and the yields, I think Rahul put it extremely well. One corollary I would add to that, I think the currency market across spot and forwards and derivatives is kind of less understood across all stakeholders. I would love to see, frankly, just as we had a monetary policy framework debate, a debate around the currency policy framework integrated with the monetary policy, because they are intimately connected, without letting go of any of the flexibility that the RBI has in terms of its FX operations. Purely as an educational concept, I think it would be great to have that study done separately. In terms of views, look, clearly the RBI is there, and the governor has consistently said, "Main hoon na." He's drawn the line on the bond yields. I think if there was anything which is sitting on bond yields, it's the governor and the RBI and the MPC. Otherwise, fundamental factors and the size of the fiscal deficit, the inflation prospects, and what's happening globally point towards higher yields. It's a tension which will play out. I'm guessing for the short term, the RBI will win because it has ample degrees of freedom given the FX side. On the FX view, I agree with Rahul. At the moment, RBI has plenty of reserves. It can pretty much control the FX wherever it wants for the next 1 year, 2 years, given the reserves it has. But over a period of time, unless our real economy recovers with output and jobs, frankly, we are looking at a weakening of the rupee, and it might not be a bad thing. I think our terms of trade have to go towards the domestic side. Can I go to my savers point now, Niraj, very quickly?
Yes, please.
Okay, so thanks for that lead question. Look, very quickly, just as the RBI is grappling with growth versus inflation, I think a less appreciated part that we perhaps don't pay attention to is it's a two-speed economy, Niraj. We've used this alphabet soup of Ks, etc. Yes, there seems to be this swathe of MSMEs and retail, etc., self-employed people who are in trouble and they need help for survival, revival, and growth eventually. There's also a sliver of the formal economy, which is doing reasonably well. Some of them are doing, even in absolute terms, doing pretty well. It reflects into savings as well. You have a bunch of people who are savers, who are sitting on money, and then you have a whole bunch of people who desperately need support and cash. Both are equally legitimate, right? Now, there is no argument that fiscal money, whatever support is possible from the RBI side, has to go to the bottom of the K. And there can be no argument about that. But if it's being done by pushing down real rates to record low levels, you are going to create other risks to financial stability. Okay, so quick statistic: the weighted average deposit rate across all fixed deposit in banks today, as of April, was 5.36%, Niraj. Okay, it's a record low. Okay, against 3-month inflation expectations of 10.4% that RBI surveys say. So you're looking at over 5% negative real rates. If you're putting money in a fixed deposit today, you'll after tax get 3.5% or something, right? Which is severely negative real rates. So you have small savers, you have pensioners, and you have people who are the formal sector, people who are sitting on cash, who simply don't have savings avenues. So you're taxing savers, you're forcing some of them to go into equity markets, to gold, to Bitcoin, to risky assets, creating some of the asset bubbles that you warn us of. You're possibly creating issues of people starting to invest overseas through fund of funds, through buying gold, through buying foreign currency assets. And eventually you might create even real inflation, consumer inflation, because of this sliver of money lying around which has no place to go. That I worry about. And I wish we would pay attention to that part as well, without compromising on the bottom of the cake. If we could, so the simple way, or one way to do it, Rahul, Niraj, rather than have the RBI or the banks monetize the deficit. If, for instance, the government did a lot of disinvestments, you're effectively selling assets to the savers and taking money from them. You're giving a savings avenue for those savers. Second way out, you offer a 5-year tax-free bond for a limited period of time at 6%. Okay, I can tell you there'll be 3 to 5 lakhs of worth of money which will easily come in for 6% tax-free for 5 years, right? Including some of the Robinhood investors who are jumping into small cap stocks, etc. who are uncomfortable doing so, if you give them a reasonable return, and this is not high cost for the government, if our country eventually goes back to the growth which it is potentially capable of, it will easily pay for this. And 6% is not a change in the headline at all. So my point is, by letting this sliver of savers, away, you are creating financial stability issues, including asset price inflation, including potential FX issues as well eventually, and of course things like consumption and inflation, which is important. So I think there are ways out of tapping the existing savings of the savers, rather than printing fresh money each time by RBI monetization or by having banks funding the deficit. It's a controversial topic, but I think there are ways of recycling the money supply rather than issuing fresh money supply and taking care of savers.
Yeah, a bunch of opinion out there over the last 3 days on social media about it from fairly decent people as well. But yeah, the point worth pondering over. Ananth, Rahul, thank you so much, gentlemen, for joining in today and giving us your thoughts around the policy and the implications thereof. Really appreciate your time.
Thanks a ton, Niraj. Thanks, and lovely seeing you, Rahul.
Sure. Yeah,
Thank you. And viewers, thanks for tuning in to this broadcast.